Hi, everyone. Brad here at Delta Awesome, helping business leaders change things into awesome. And I want to talk today about not just startups, but general capital financing of companies. I've been in the venture capital world one way or another, one foot in, one foot out since 2010. I have helped hundreds of companies with seed, angel, and Series A rounds. I've helped companies exit. I have been there, done that. I've just never chosen to be on the capital side myself. Now, with that legitimacy out of the way, what do I want to talk about today? Well, today I want people to start to realize that we're in what we're calling end stage software as a service venture capital model. The venture capital model has been around for a long time. It was kind of perfected or tweaked in the 90s, early 2000s. They started really solidifying what is this thing? How does it work? Basically, cheap liquidity coming in from private capital, creating funds who then go out and seek really good ventures and opportunities. I would say the heyday of this peaked in 2013. Most people don't think it's that far back. I think that was the peak. But after a peak, there was a long ride till about 2022 where this still looked like a viable model, but I believe it was already in the end stages of this model. Now, when you add in baby boomers' retirement, increased costs of capital, less IPOs, and a difference in model, especially because of SaaS and AI, we're in the late stage of that. Cool. Well, what's coming next? Look, Americans are not stopping being entrepreneurial. That's not happening. And there aren't no longer good ideas, whether they're in tech or hardware or food. There are a lot of entrepreneurs out there who feel more emboldened than ever to start. But the capital model is going through a change, and it's subtle and it's difficult because right now the old version just isn't working so well. I actually know two VC funds with over 100 million. Oh, and one's a second, one's a third million fund where they are concerned about what's called capital calls. Now, a lot of people don't know what this is. You don't really need to know what this is. But the bottom line is a capital call is venture capitalists don't sit on the money. They have they have contracts for the money from the people who have it. They're called their limited partners. And when they have an investable deal, they go and they call in the capital to make the investment. So it doesn't sit in a bank account. They have to call it. There are people who are worried that they won't be able to call their capital, and the only thing they can rely on are their legal contracts. Well, anyone who knows negotiation theory, any venture capitalist who sues an LP for a capital call, that's the last time they're going to be working in the industry. So it's kind of a catch 22, you're screwed either way. Now, where I'm going with all this late stage venture capital, SaaS model stuff is new things are arising. And that's what I really want to talk about here today. One of the things I'm seeing arising a lot more are cash flowing companies whose job is not land, expand, infinite scale. Land, expand, infinite scale is something you can do with software as a service and technology plays. But with other plays, hardware, physical goods, textiles, leadership, foundational core needs like the need to meet, the need to eat, the need to associate, these companies, they don't fit in the venture capital model. They won't fit in the venture capital model. The entrepreneurs are not looking to fit in the venture capital model, but they still live within a financing model. They still have the ability to say to people, give me the startup capital I need. I will give you debt, royalties, and equity back. It'll be better on a risk adjusted basis than you putting it anywhere else you are going to see today. It is an alternative investment vehicle. It is not the stock market, but it is more valid and viable than anything else you're going to see. And I'm seeing this a lot. But the thing that happened three times last week, one is a hardware play in material science, one is a private equity person, and one is in food. So hard goods, big capital expenditures. We're talking 10, 15, 20 million per unit, selling dozens of units a year. We're talking about private equity people who are coming in, buying lower key companies with 1, 2, or 3 million in EBITDA, not 5, 10, and 15, and food, which is high volume retail sales. All three of them, they decided to design their capital stack a little bit differently. And the little bit differently was raise the amount that they need, no more, no less, and give a guaranteed payback, which for us finance nerds, we would call a version of debt. Some of them are calling it royalty. Some of them are calling it liquidity preference. Some of them are calling them alternative payback methods. The bottom line is the investors eat first on the gains. They have baked in gains, usually somewhere in the 2 to 3x. And then they only get a little bit of equity as a kicker. So the prime example, the big capital expenditure one, was a 3x liquidation clause that is bought down through royalties. In other words, it exists in their capital, but you can buy back the stock through royalty payments, pre-agreed payments, and the company will in the end buy back 80% of the initial financing through royalties. So both parties are coming together and doing something a little novel. They're both saying, "Hey, if it's worth this much, I will clear my as the investor, I'll clear my risk. I'll get a risk adjusted return, and then I'll keep just a little bit of the upside as my lottery ticket." The company on the other side is saying, "Hey, we can actually afford to pay this back on our own schedule, and when and as we pay it back, we gain a greater version um, of the lottery ticket." Now, why would I go about doing this or talking about this at all? This is a complete change when I see this three times in three different expressions from three different fields, from huge capital expenditure, large markets, international. When I see it from private equity companies saying, "What would I take to make my LPs happy?" And they'd say, "We're half venture capital, we're half private equity," we would take that deal. And then finally, from the food perspective, that was a really interesting one because that one also allows the company to effectively say, "We've had debt for a while. Our debt is through our investors, but we know how to manage the financial tools of debt instruments so that when we're ready, we will be able to go out to the commercial market for debt. And we're already prepared for that. We're not so hooked on this concept of get equity now and have just one check later. We're used to the concept of paying things back over time." Complete alteration from the late stage software as a service venture capital, which is put more in, put more in, put more in, be the winner, dominate the market, get as much as you can, and then exit at a crazy multiple to a larger scale strategic who needs you. That model isn't here. And that model isn't this supreme cherry awesome model. This is something different. I personally like it, but I also just want to acknowledge it's different. As always, thank you for your time.